Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm joined by Clive Thompson, an expert in the precious metals and sound money field with an unblemished 47-year career in trusts, wealth management, and Swiss private banking. We are going to be discussing gold and silver, the metal, and the miners, along with getting his thoughts on where to find value in markets today, where investors should look for yield in a falling interest rate environment, and so much more. So without further ado, here is my conversation with Clive Thompson. Well, let's begin by discussing the gold sector. Obviously, an incredible year so far for gold, although we have seen a pullback sitting just above 2,600 today. I'm wondering, when it comes to looking at the longer term time horizon, are we still in the early stages of a gold bull market? Was it starting to get overbought? Is this pullback temporary? How are you currently viewing the gold sector?
The last major bull market lasted more than a decade. That was from the around 2000 to 2011 or 12. So we're very much in the early stages, in my view. I'm not saying the next one will last 10 years or 12 years. I think it could last infinitely longer, because we're in a phase now where the monetary expansion is likely to carry on ad infinitum. The levels of government debt are likely to grow ad infinitum. And I think that in itself probably means that the gold price continues to rise for the very long term until something breaks.
And how are you viewing the silver market right now? Because silver, a metal that has disappointed many, especially if you've been holding since, 2013. It was only recently we saw a return to those price levels adjusted for inflation, obviously lower than that. And now we're back down to just above $30 an ounce. The cries of manipulation obviously come out at this point. In your view, how manipulated is the silver market, and what will it take for silver to get back to previous all-time highs?
I have never been able to discover any evidence of manipulation. I mean, I'm not close enough to the market to say that's true. Um, Certainly there are sellers who go short in the market, and that would include some very big boys with deep pockets. But I would rather look at the supply and demand and where silver's going. Now, a lot of people have got their eye on a $50 price. And the reason they got their eye on a $50 price is because that's where it peaked back in the 1980s. But if we adjust that number for inflation, that $50 price really should be well over 100, perhaps 150 or something like that. So how high can silver go? I think it can go an awful lot higher. The real situation we got with silver is a supply and demand imbalance. The industrial demand plus cutlery, jewelry demand exceeds the mine supply. The mine supply of silver has been dropping for the last decade. It dropped. It's lower now than it was a decade ago, and it continues to drop. Whereas at the same time, the demand for silver, particularly from electronics, is rising rapidly. So the electronics use of silver, driven in part by the photovoltaic industry, is rising by about 20% a year. That's not likely to stop, because we're going to have more and more electronics year after year. So in 2022, for the first time, at least in more than a decade, we had a situation where there was a deficit of silver relative to the mined silver. That deficit became bigger in 2023 and is likely to be much bigger in 2024. So we're in a situation where the demand for silver for industrial use is exceeding the supply, and that gap is going to get bigger and bigger as the years go by. The only way you can fill that gap is to recycle silver, and to recycle silver, that means people bringing in their candlesticks, or somebody taking their silver coins or their silver bars and cashing them in, or selling an ETF and they sell it back to the market. The only way you could supply that gap is with higher silver prices. So I do think silver prices will continue to drift higher, maybe go in spurts, like the one we saw a few weeks ago, when almost in days silver went from around 30 low 30s. It rose by 6% in one day. 7% one day. It went up to 35, maybe $36. then it's obviously pulled back now by about 20%. So we could have those sort of moves, sudden, sharp movements, and it's very hard to burrow down and find out what causes them. But when they do happen, what it does do is cause all the shorts to run for cover. So when the price move starts, all those people who are short, there'll be an equal number of people who are short and long. All those who are short suddenly say, oh my God, it could be on its way to 50. And then they rush to cover. That causes more buying, spiking the price higher than it should be.
Hey guys, just a quick break to hear from today's sponsor, ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And pivoting back to gold for a moment, I wonder if you could maybe go into some more detail on the catalysts that you see potentially driving the price higher. Obviously, we now have a rate cutting cycle occurring globally. A lot of people have pointed out that gold's rise was in the face of high interest rates, which is unusual, as well as a strong US dollar. And now that a rate cutting cycle has begun, perhaps this could fuel the next leg of the bull market. Obviously, central bank buying has been a big story. What are you watching specifically when it comes to catalysts for the gold price?
There is a fairly weak correlation between interest rates and the gold price. In other words, falling interest rates are positive for gold, but it's a weak correlation. It's certainly not the major one. I think the major one affecting the gold price at the moment are worries about the level of US government debt and the fact that the budget deficits are forecast to grow larger, and there's, as of now, no sign of the US government addressing those problems. To solve it, they would need to have a mixture of raising taxes and lowering costs. And of course, the political will to do either of those is not very high. So the feeling is, and not only the feeling, the projections from the US government's from the Congressional Budget Office, the projections are that that deficit is going to grow and the level of debt relative to GDP is going to grow. What does that mean? It means the debt levels are increasing faster than the economy is growing, and that means that it's in an unsustainable situation. And it's not just me saying that. We have very venerable people like Jerome Powell who've said this is unsustainable. I won't go into the long list of people who've said it, but everybody who's in the know basically knows it can't continue like this, because at some point something breaks and then all hell breaks loose.
Let's pivot to the gold and silver mining sector. This is an area that a lot of people see as extraordinarily undervalued or some kind of trap, either or, because we are seeing a big pullback in the GDX as we see gold dropping to around 2,600. And along the way, I believe GDX has returned basically on par with the metal itself over the course of the year, very close to that. More people were expecting the miners to be a levered play on the gold price. It hasn't exactly turned out that way. I wonder what your thoughts are on both gold and also the silver miners right now and any potential opportunity they present.
Traditionally, gold and silver miners outperform on the upside and underperform on the downside. We've had a decade when that's not been true. If we were to return to some sort of normality for the gold mining sector and the silver miners, the price of those shares probably would have to double from here just to keep pace with the present gold and silver prices. I think the reason why we've had this underperformance, we obviously had this decade from about 2012 onwards to 2021, 22, when gold was doing nothing. It sort of went into a giant saucer shape and didn't really go anywhere. The problem with that was a lot of people were looking at the massive bull market going on in stocks and saying, my God, I'm missing out on the latest hot stock. Where can I get the money? And they look at their portfolio and they say, I've had this gold mining stock for 5 years or 10 years or 3 years, whatever it is. It's a dog. Sell it. And then they go and buy Nvidia or Microsoft or Apple or Facebook or whatever the hottest stock of the day is, whatever they've got their eye on. So I think what we've had is rotation out of gold mining stocks into the, let's call it the Mag 7 for simplicity, and people are chasing hot stocks. At some point, the mining stocks will be the outperformers. We're not there today, but at some point they will be. And when that happens, I think we'll see that money coming back into the mining stocks, propelling them much higher. So one of the problems the mining sector has faced is rising costs. In the last couple of years, we've seen the cost of mining rising by something like 35%. That's since 2020. And the reason for that is mainly labor costs going up. But of course, with the gold price rising much more than that, we've got this leveraged effect on the bottom line. So gold mining companies are this year reporting absolutely outstanding results. And it's only a question of time before that starts to get reflected. There's probably still a lot of people who don't quite believe that gold's in a bull market. They say, it goes up and it goes down, it goes up and it goes down. But I think we've turned the corner on the gold price. I think we've kissed $2,000 goodbye. I think the next stop is $3,000. My personal view is we're going to be heading, if we're going to try and keep pace with the level of government debt, we should be well into the 5,000s by now.
Well, you mentioned the Magnificent Seven there. A lot of people have been pointing to the broad market as being in a bubble, due for a correction. Depending on who you talk to, you get different estimates, from kind of a slow grinding decay to a more dramatic sudden drop. Trump takes office and we see the S&P, the NASDAQ, and the Dow Jones take off to new all-time highs, as they seem to continuously do. Should we all be just buying the S&P at this point? Or what is your thought on the performance of the broad market?
Frankly, it's the last thing in the world that I would buy. And the reason is not because all 500 companies are duds, but the top 7, if you like, are priced at levels which don't really offer a lot of value. I think if you look around in stock markets, and I'm talking globally, not just the USA, you'll find plenty of very attractive companies, but you won't find them in the top 7. So if you buy the S&P 500, almost all of the value, that S&P 500, is in those top 7 companies, the overpriced companies. And why are they becoming so overpriced? People are, there's something like $6 trillion of cash sitting on the sidelines looking for a home, or potentially looking for a home. So people feel they're missing out on the stocks. They say, maybe I can't buy Nvidia, it's too high. All these stocks, I missed the boat. So then they go look for a fund, which has been performing very well. And their advisor says, well, here's a list of funds. Look at this one, it's done so well. Look at that one, which has done so well. So they buy that fund, which happens to be a fund which owns the top performing stocks. That's why it's done well. So as they buy the fund has got cash, and it's got to buy into those top stocks, propelling the prices even higher. So we have got to a situation where we're more than fully priced. I'm hesitating to say overvalued, because some might argue that. But there's no shortage of money still looking for a home. So it's not to say those stocks couldn't go a lot higher. But if I was deploying money, and I am deploying money all the time, I always look for something which is offering better value for money. So will we have a crash in the S&P 500? It can happen, but you never know. I mean, let's look at the period from 1994 to 2000. By 1994, we were fairly overvalued in the markets, and the bull market lasted for another 6 years. So you just don't know how long it can last. I'm not going to say we're going to have a crash tomorrow. It'd be nice to sensationalize these things and say it's going to happen tomorrow. It could, but the way you protect yourself is by not having all your eggs in one basket, and definitely not in the top 7 companies.
Well, let's talk about where you are seeing value in the markets right now. We discussed gold and silver. I'm wondering when it comes to commodities, if there's anywhere else you think looks attractive, whether that's energy, uranium, base metals such as copper. Where in the commodities complex do you think looks good right now?
Well, first of all, it's quite hard to directly buy commodities like copper, nickel, wheat, and so on. Or if you're buying wheat, which fund is going to buy wheat and store it, or live cattle? It doesn't work. So, if you want to buy one of these, and there are notes out there which are connected to commodities, you're suffering from something called the contango, because what these funds do, they don't go if you don't go and buy the commodity itself. They buy the futures. They buy the 6-month futures. And the 6-month futures are trading at a higher price, usually, than the 3-month futures, which are trading at a higher price than the 1-month futures. So when they buy these futures gradually approach from 6, 5, 4, 3, 2, 1. And then as it gets closer to day zero, the fund will sell the short-dated contract and buy another long-dated contract. But they're constantly buying the longer-dated contract at a higher price than they're selling the short-dated contract. That's called the contango. And the net result is you might see the underlying commodity rise in price, but the fund you bought is going down. So I don't recommend anybody to go out and try and buy these things directly, either through a fund or if holding it physically. You can't really store a lot of these things. The way to do it, in my opinion, is to buy resources companies, and the practical way to do that is to buy an ETF. That's an exchange traded fund. An exchange traded fund is a fund which holds usually hundreds of shares in an index. So there are indices which are called resources. So a resources ETF, exchange traded fund, will hold all the stocks, or the 150 largest or the 100 largest stocks in that index. So if you buy a resources ETF, and they'll be on offer from all the major ETF providers, you'll end up with a lot of the largest companies in the world who are mining, drilling, and growing. And then that way you've got your exposure to commodities. But yeah, if I wanted to home in, I mean, clearly things like copper, nickel are going to be in demand. Uranium, I think, is a good one, because the world is going to probably have more nuclear power stations. It's a natural thing to have when you're trying to reduce emissions. But to home in on one particular commodity, I think they're all good, really.
Yeah, and I appreciate that comment concerning the ETFs versus futures. I personally take the ETF approach and then use smaller amounts of capital to speculate on individual companies. But yeah, if you believe in the whole sector, then I agree that an ETF is the best way to go there. If we step outside of the commodities space, is there anywhere else, like outside of the US and Canada, outside of North America, whether that's emerging markets or other areas, Japan, that you potentially see value in right now when it comes to the equities markets?
Absolutely. I see a lot of value in in several places outside the USA. But to be general about it, I think across Asia, it's not expensive. It's very cheap. Particularly cheap is Hong Kong and China. Now, I know a lot of people don't like China, and therefore they don't like Hong Kong, because it's now part of China. But if you take the view that you'll still be able to trade Chinese stocks 5 or 10 years from now, and maybe this present situation of slowdown in the Chinese economy will be over, you're picking up Chinese stocks right now at price earnings ratios below 10, with much more growth than you're getting in the typical Western company, and generally quite high dividends. So that's an area to look at. Another area which I think is rather undervalued is the UK. The UK is offering a lot of value, but moving on from there, I think you could probably buy any of the emerging market funds. And again, the way to do this is through ETFs. We've mentioned that. So probably what I'd be saying to investors in America is look to diversify internationally because you'll get more value overseas than you're getting in the United States at the moment. The USA, the US stock market has pulled ahead much more than other markets, and it's pulled ahead much faster than is justified by the growth in earnings. So the valuation gap between the US markets and other markets has widened, which is an opportunity for those who've got US stocks to maybe move some of it into overseas stocks. So that's what I'd be doing. And if you wanted to focus, I personally I do like Japan, I do like the UK, I do like Hong Kong, and I do like, in broad terms, emerging markets. But it's not to say that I would emerge places like Australia or Europe in general. I mean, everywhere you look, you'll find bargains if you look hard enough. And one of the things I encourage people to do, if they either they buy an ETF and let someone else do the hard work for them. And if you're doing that, I'd probably go for ETFs, which have got maybe a value ETF, maybe a dividend ETF, and then perhaps mix it in with a growth ETF. But if you want to go looking, you can find some amazing discrepancies. I won't name specific stock names because I think that's probably getting a bit close to investment advice. But just as an illustration, I was looking at the UK market a couple of days ago, and I had a UK company. It's a very, very large investment company, probably the largest in the UK, investing in other companies. So private equity, if you like, but it's quoted on the stock market. And I became quite concerned because I discovered that it was trading at something like 66% above its net asset value. But it had a fantastic growth rate to justify it. So I looked at where's this growth came from. And then I became shocked because I discovered that all of the growth was coming from one company in their portfolio. They have 70% of their portfolio in one company. So I took the decision that I'm going to sell it. So I went looking around for something else in the same sector, private equity sector. I quoted investment company in the private equity sector. I looked at quite a few, and I found a large one, a couple of billion, $2 or $3 billion worth in the UK, which is trading at a price which is 66% below its net asset value and has got market-beating growth over the years, been around for many years. So if you look, you'll find these opportunities. I mean, on the one hand, there's companies which are overvalued. That one was 66% higher than its NAV. Another one 66% below the NAV. The one below is highly diversified, nothing riding on one stock, beating the market. The other one's beating the market by a bit more, but it's all due to one stock. And that's, a risk factor, which should have a bigger discount. So what I'm saying is look around. If you're looking for some particular type of company, look at 2 or 3, and you'll find that some are cheaper than others. But if you're not sure, ETFs are the way to go.
You alluded to it there when discussing China and Hong Kong, but I wanted to expand a little bit on that in terms of those securities potentially getting sanctioned, as we saw with what happened to Russian stocks as well. Because obviously we have heard that China is presenting a lot of value right now, but there's always that concern. Is this a question of position sizing for you, maybe allocating a smaller percentage of capital into the Chinese space in anticipation of a potential situation like that? How do you view that?
Whenever you invest anywhere, you have to accept that there is a risk that something might go wrong with the country. And you can't necessarily see what might go wrong in advance. So the risks you can see are already priced in. So in terms of China, you're getting an awful lot for your money. You're probably getting 3 to 4 times as much for your money as you would in the United States. So what does that mean? It means whatever you would have allocated to China, you only have to allocate a quarter as much to get the same sort of value as you're getting out of the United States in terms of. So if you allocate $100 to the United States, you might be getting $2 or $1.50 in dividends. You allocate the same to China, you might be getting $6 in dividends because the yields are 5, 4, 5, 6%, much higher than the United States. So you don't have to allocate. So if you say my allocation to China would be, 5%, for example, or let's say 10%, you don't have to allocate 10. You can allocate 5 because you're getting twice as much for your money. So yes, the answer is when you do allocate to any region of the world, you want to size that position to allow for the risk that something might go wrong. So I have a personal strategy where I try to make sure that no country ever has more than 20% exposure.
Very interesting. I want to talk about the debt and deficits in the United States. You alluded to that as one of the catalysts for the gold price. Trump being elected president, obviously, a lot of people who watch this show, I think, are happy. I'm politically homeless myself. I don't like politicians. Um, However, one thing, we're hearing a lot of things about how he's going to, clean out the CIA and the FBI. He's going to restore, free speech, et cetera, et cetera. But the debt and deficits is something that is not, you can't just snap your fingers. Apparently, Elon Musk is supposedly going to be taking care of that. We'll see exactly what happens there. But we also hear a lot of language like, it's the fall of the Western Empire. This debt's going to lead to, in extreme cases, a Weimar Germany style hyperinflation. When you talk to people who are maybe on that side of the spectrum, you talk to others who say the US economy is actually extraordinarily strong. They can kick the can down the road for much longer than people anticipate. I wonder what your take is on the debt and deficits in the US and how that situation resolves.
First of all, my feeling is that we've passed the point of no return already. In other words, I don't think it's possible to do anything about the level of debt and the fact that it's going to get worse without some very dire consequences for the United States. Sorry, just something beeping there, stop that. So, and one of the reasons is the governments have got into the habit of overspending, and if you start to withdraw that, well, which politician is going to vote for withdrawal of the spending? You're going to take away Social Security? Well, you have a revolution on your hands. You're going to raise taxes? Well, Americans are going to, the people who pay your bills, the rich, the Elon Musks of this world, are going to be having a word with their politicians saying, look, I supported you. What are you doing raising the taxes on me? So I think it's very difficult to do anything about it. But the other problem is the interest question. The level of interest on the national debt is rising very fast for two reasons. The first reason is a lot of money that they borrowed over the last decade, 12 years, they borrowed at very low rates when interest rates were effectively zero. So they could borrow money on 5-10-year bonds at interest rates of 1 or 2%. During the next decade, all of that debt, most of it is going to be maturing and has to be replaced by new debt. And that's already happening now. And as it gets replaced, it's being replaced by new debt, which is costing them 4.5% a year, or 5% a year, or 4% a year, depending on what maturity we're talking about. So it's costing them, let's call it for simple terms, twice as much. So during the previous decade, although they were spending more, the debt was getting bigger and bigger, the interest rates were going down, so the interest cost didn't rise very fast. But now we have the double whammy of rising interest costs because we got maturing debt having to be refreshed at higher interest rates, and a widening deficit which has to be financed, and that has to be financed at the new higher rates of well over 4%. So that interest cost is going to spiral out of control. If I put it in a family context, can you imagine if you had a credit card and the debt gets bigger and bigger until one day you wake up and you find that the interest cost is greater than your earning? And that's the road that the United States is currently on. If they don't do anything about it, within a decade, we'll find that the interest cost exceeds the total of their tax take.
So for your average person out there who wants to protect their wealth in the face of this scenario, is physical gold and silver the best way to go? How would you look at preserving purchasing power in the face of these rising debt and deficits? Obviously, more money is going to be printed. And do you anticipate inflation to continue to be an issue moving forward?
So you want to protect your place in the in the wealth chain. So, we've got the people at the top of the chain, the billionaires, then the millionaires, and then the people who've got 100,000, then people who've got 10,000, then the people who've only got 500 quid. Whatever you've got, you don't want to be going backwards, relatively speaking. And the one sure way to go backwards is to hold cash, because the money and the level of debt is being inflated at a much faster rate than you're earning interest. So even if you're getting 5% on your money, the level of government debt is being increased by 7 or 8% a year and rising. That's going to go faster. So you're going backwards, and that's before you paid your taxes. So realistic speaking, the place to put your money, the place not to put your money is cash or bonds. You're not going to go forwards with those assets. You'll go backwards. So if you want to preserve your wealth and save for the long term, you need to be in other things. And that also depends on how much your wealth is. For the average Joe, he might not be very sophisticated. He might not know much about stock markets or other things. So a good way to protect your wealth is to buy the things you might need next year or the year after or 5 years from now. I'll give you some examples. You might be thinking, well, Nick, I'm going to start exercising next year. Well, why wait till next year to buy your exercise bike? Why not buy it now? Maybe you could do a home extension. That's a good investment. Maybe you could do a loft conversion. Maybe you can have your garden redone. That's a good investment. So it all depends on how much you've got. But of course, if you're very wealthy, then you have capital to deploy in financial assets, and you need to be looking at things like precious metals as one of your investments. Now, I say one of the investments because you don't want to have too much into anything. I have published on LinkedIn several times over the last few years what I call an asset allocation table for millionaires. And that has consistently shown 6% in gold, 6% in silver, so 12% in precious metals. That could extend to platinum and palladium, which I think have also got their characteristics for investment. But the rest of the assets should be in things like equities, property. Now, you can access property through real estate investment trusts. It doesn't mean to say you've got to go out and buy a flat and rent it out. That might be a lot of work. I mean, if you've got the appetite for doing it, why not? But for a lot of people, they say, I don't want the trouble and the taxes which come with owning a piece of real estate, and then I've got to deal with the tenants and all sorts of things can go wrong, like repairs and so forth. If you don't want any of that, you buy a real estate investment trust, which will invest in a particular category of property. It might be investing in apartments, it might be office blocks, it might be hospital, medical facilities, it might be shopping malls. But each real estate investment trust has got its own particular theme. And so you have a lot of choice as to which one you invest in. Another thing you invest in is anything which is tangible. Now, I like if you've got enough money, and not everybody's got the sort of money that's required for this, but private equity is a good investment, and you do that through a collective scheme. If you haven't got enough money to go in for one of these so-called limited partnerships, you can always buy the private equity companies which are quoted on the stock market. And then, of course, there's a range of financial instruments from different types of funds. There's structured deposits, there's hedge funds. I'm not a big fan on those sort of things, so my exposure to structured investments and customized investments and hedge funds would be very low. But as a diversification point, it's not a bad idea to have some of those, so you don't have everything riding in the same direction. And other things you can do, if you have a mortgage, you can think about reducing your debt. That's a good investment, because don't forget, on a mortgage, you might be paying 7% interest, but you're not getting any. I don't know about some countries, you might get tax relief, but in many countries, they don't give you any tax relief for the interest you're paying. Where else can you get an investment which is worth 7% tax-free? Answer: the only place is to pay off your mortgage or your credit card debt. Of course, you should pay your credit card debt if you have one before you pay your mortgage. I think those are some ideas. And in terms of gold and silver, I think it's a good idea for everybody to have a few gold and silver coins at their house. Perhaps your first stop should be the old silver coins of the realm. So whichever country you're in, they used to have silver coins, all countries did before a certain date. You can go to dealers and buy these bags by the kilo. A kilo doesn't cost much. It's less than $1,000 anyway. You can check with the dealer. But and if the world gets into a crisis situation, the currency fails, or nobody wants to take your currency, hyperinflation, then of course your gold and silver coins are going to come in very useful.
I want to follow up on the real estate investment trust comment. Where are you looking in that particular sector at the moment? Because we hear a lot about real estate being in a bubble in a lot of different countries. Commercial real estate in many parts of the US, people have pointed to as being in a bubble. In my home country of Canada, buying an average house has gone up such an incredible amount. I wonder where you think might be a good place to look for value when it comes to the REITs.
The first thing I like are real estate companies which manage an eco-structure which comprises an area, perhaps around a major railway station, where they own the apartments, they own the office blocks, they own the shops, and they own the entertainment or theme parks or whatever is there. So they're managing an entire ecosystem. And by having that management of an ecosystem, as opposed to just owning apartments or just owning office blocks or whatever, they can manage it in such a way that they can be quite flexible to get the optimal amount of the optimal mix of tenants and businesses, so one feeds off the other. If you get the right number of offices, the right number of apartments, and you can then get the right number of shops to go with it. And of course, there's obviously transport systems, there's entertainment. So by bringing all that together, that's a very good strategy because they can optimize the returns. And so there are some real estate investment trusts around which specialize in doing just that. They'll acquire different pieces, but once they've got their area around the center of town or around a railway station or some hub, they can then build on that by consistently buying more and more stuff which comes up for sale in the region, growing the area. So that would be a good one. Another one which I quite like, but it depends on the country. It's very country specific, but it's the real estate investment trusts investing in housing. But again, it's the right sort of housing. There was one I invested in the UK. It's been taken over recently, but it was invested in what they call assisted housing. So this was a sort of housing for people who effectively have to be on benefits because they have a disability. So although the tenants themselves are paying the rent, that rent is, to all intents and purposes, funded by the government. So I'm not talking about down and outs here. I'm not talking about druggies or anything like that. I'm talking about people who perhaps got mental difficulties or physical difficulties, so perfectly sound of mind, perfectly normal people in every other respect. But the government, because of their need to have these housing facilities, the government is, to all intents and purposes, paying the rent, even though it does come via the person concerned. That was a very safe bet, and it was yielding, I can't remember the yield, but it was a pretty high yield. Maybe it was 10%. And if you look around, you'll find these sort of things where you can say the rental stream is as good as government guaranteed. That's a good one. Here in Switzerland, where I live, I've bought a number of the Swiss real estate investment trusts which invest in Swiss homes. Switzerland's a very small country. We have the whole world trying to squeeze into tiny Switzerland because the salaries in Switzerland are one of the highest in the world. And anybody who arrives here finds one of the things which gives them a problem is finding somewhere to live, because it's, first of all, you have to pay up, and there's not a lot of choices. So that's, I think the downside on Swiss property is quite limited. So that's why I buy it. And of course, if you're a Swiss resident, they give you a big tax break. I'm sure in other countries, for some countries, not all, there'll be tax breaks on their real estate investment trusts. So yeah, it depends. You've got to look around and find what will work for you in your area. Housing's always a good bet, I think. because we're living in a world where there's not going to be any less people trying to squeeze into the houses.
Great thoughts there. I want to end on discussing fixed income, where the best place is to get yield. Obviously, you mentioned that REITs themselves can provide a decent yield. You said you might stay away from the bond market. Is that correct? At least when maybe it comes to the U.S. side of things. Are you looking at emerging market debt at all right now? What are your thoughts on the fixed income space at the moment?
There's nothing wrong with having some fixed income. I keep it low. That's, I suppose, my point. Uh, and I keep it low because I think you're going backwards. If you are in the fixed income space, first of all, I would make sure that it's very short dated. Now, what short dated mean? It means you're in the sort of 1, 2, 3 years space, not the 5, 10, 15, 20-year space. The way you can get into the short end is to buy, again, we have in most countries ETFs which invest in short-dated debt. Particularly the USA, you'll find that there's all kinds of ETFs which specify what they call the duration of their portfolio. And you have ones which are short duration, medium duration, and long duration. But just moving outside of the sort of traditional bond space, there are all kinds of specialized funds if you can access them. And I use the word if, because a lot of these funds are not, inverted commas, allowed, or your bank, yeah, they are allowed if you know how to do it, but your bank will say no if you're what's called a retail investor. But if you're a sophisticated investor, that means you know what you're doing or you have a certain level of wealth, they're available. And these would be, as I'll give you some examples, there's a class of bond funds called cat bonds. That stands for catastrophe. They're issued by insurance companies. They have pretty high yields. And the reason they have high yields because if there's a catastrophe, and if a particular catastrophe is related to that bond, and let's say that bond is insuring, I don't know, motor cars, for example, and a catastrophe would be there's some major event which wipes out millions of motor cars. If the losses exceed a certain level, then you lose your money or part of your money on the bond. So a California there's undoubtedly one of these bonds linked to the California earthquake. What are the chances of that? But the way you manage that is through a fund, and these funds will own 20, 30, 50 bonds, each one linked to a different risk in a different area and different part of the world. So your chances of losing all 20 or 30 bonds in a fund it's effectively zero, short of nuclear war. So that's got a high yield. Another type of bond that they have, which is again regarded as high risk for sophisticated investors, is known as COCOs. These are the bonds which are issued by banks, which can turn into equity or turn into nothing at all if the bank gets into trouble. So they're the last to be paid. Some people will recollect that there was a lot of noise made about a Credit Suisse COCO bond a year or two ago. Credit Suisse effectively had to call on government help to save it, and then it was bought by UBS. But they had issued bonds which said, in the event that we ever have to call on government help, these bonds are worthless. And that's what happened. They had to call on government help. The bonds became worthless. A lot of people screamed blue murder because they said, hang on a minute, how can bonds rank after equities? Because the equity holders still got their shares. We've got nothing. But that's what it said on the face. That kind of bond is known as a COCO, contingent convertible. So that has a very high yield for obvious reasons. You might lose all your money if the bank gets into difficulty. Then what else is out there? In the stock market, you've got these high yield funds. These are equity funds which invest in higher yielding shares, and they'll pay a decent dividend. There's ETFs which do that. I know Vanguard has got one, for example, but there's a lot of them out there. That's another area to go. And I just mentioned something which some income investors might like. They may have heard of the dividend aristocrats. A dividend aristocrat is a company which has increased its dividend every year for a certain number of years, let's say 10 or 20 years. So there are funds which only hold what's known as the dividend aristocrats, available in the USA, in Europe, globally. So if you have such a fund, you're virtually assured, not guaranteed, that your dividend will rise every year because it holds 50 or 100 stocks, every one of which has always increased its dividend and is expected to, and forecast to, increase its dividend again next year. And therefore, you get a rising income stream, which might be useful if you're young, heading towards retirement. You're going to need a rising income in retirement. And another area which involves extreme risk is the types of ETFs which sell options against the portfolio and pay that option premium to you as a dividend. Now, there we're looking at yields of 35 to 100%. It seems extreme, but the risk is because they're selling options, they're effectively capping the upside on the fund. So if the markets have a melt up, you're going to miss out on that. If the markets have a meltdown, you're participating all the way down 100%. So these sort of ETFs which sell options are only attractive if the market sort of is steady as you go and doesn't have big swings. But history says we will have big swings. But if you want a 35% yield, look for one of these yield max type of ETFs which sell the options, and it's all done by computers. It's not human beings sort of looking at a screen, so I'll sell that one, I'll sell that one. And the computers are just doing it automatically. There are some which even sell what are known as zero-day options. So these are options which are issued in the morning and expire in the evening. The risk might not be very much, but you could, in the middle of a day, have a large price movement which effectively caps your upside.
Very fascinating to hear about all of those things. Catastrophe bonds is an area of the market that I've looked into somewhat in depth. I'm very interested by that. It requires a larger amount of capital. There's currently no publicly traded ETF for catastrophe bonds. That may change in the future, but there's some interesting subcategories there. There's mortality bonds that basically you're betting on a population either outliving or underliving its estimated lifespan, which is super interesting too. That's an area I'm watching. We'll see if an ETF ever comes into being.
There is no ETF, but there are funds which you can buy, at least here in Europe. They're UCITS funds, which you can buy in Europe, which are invested in catastrophe bonds. I mean, I haven't owned one myself, but I know it's out there if I wanted to.
Well, Clive, this has been a fantastic conversation. Tons of insight shared, so I really appreciate that. For those who want to hear more from you, where's the best place to go online?
I really only communicate via LinkedIn. I'm suffering from email overload. It just drives me mad to go and look at my box. Every time I look at my email box, I find there's 100 new emails to read, all from spammers of various descriptions. So LinkedIn, at least, there's a lot of control over dodgy emails. So that's the way to communicate with me. Anyone who's on LinkedIn can write me a message privately, of course. It's all private. And I'll be happy to answer their questions on finance or investments generally. But I don't give investment advice, but I do, and I have nothing to sell, but I do help people see if they've found their way in terms of what they're thinking of doing.
Fantastic. I'll put a link in the description below to your LinkedIn profile. Thank you once again, Clive, for coming on and sharing your knowledge with the audience.
Well, thank you very much for having me on your show and all your listeners.
And thank you for joining us today. This episode was brought to you by ARC Silver, Gold, Osmium for all your precious metals needs. Head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.